Hi everyone, welcome to our video on how to analyze a balance sheet of a company. In this video, we will go over the key elements of a balance sheet and the important ratios that you should know to understand a company's financial health. Let's start with the definition of a balance sheet. A balance sheet is a financial statement that shows a company's assets, liabilities, and equity at a specific point in time. It provides a snapshot of a company's financial position and is an important tool for investors to evaluate the company's financial health. Key elements of a balance sheet. The balance sheet is divided into two sections: assets and liabilities and equity. Assets are the resources that a company owns and controls, such as cash, investments, property, and equipment. Liabilities are the obligations that a company owes to others, such as loans, accounts payable, and salaries payable. Equity represents the residual interest in the assets of a company after deducting liabilities. Important ratios to understand. Now let's talk about the important ratios that you should know to understand a company's financial health. Current ratio. The current ratio is a measure of a company's ability to pay its short-term debts with its current assets. The formula for the current ratio is current assets divided by current liabilities. A ratio of 2 or higher is generally considered good. Debt-to-equity ratio. The debt-to-equity ratio is a measure of a company's leverage. It shows the proportion of debt financing relative to equity financing. The formula for the debt-to-equity ratio is total debt divided by total equity. A ratio of 1 or lower is generally considered good. Return on equity, ROE. The return on equity is a measure of a company's profitability. It shows the amount of net income generated by each dollar of equity invested. The formula for ROE is net income divided by total equity. A high ROE indicates that a company is using its equity efficiently to generate profits. Gross margin. The gross margin is a measure of a company's profitability. It shows the percentage of sales revenue that remains after deducting the cost of goods sold. The formula for gross margin is gross profit divided by sales revenue. A higher gross margin indicates that a company is earning more profit from each sale. Conclusion. So, that's it for today's video on how to analyze a balance sheet of a company and the important ratios that you should know. By understanding these ratios, you can evaluate a company's financial health and make informed investment decisions. Reading a balance sheet of a company may seem overwhelming at first, but it can be broken down into a few simple steps. Here is a step-by-step guide on how to read a balance sheet of a company. Look at the date of the balance sheet. The balance sheet is a snapshot of the company's financial position at a specific point in time. Make sure you check the date to see how recent the information is. Identify the assets. The assets are listed on the left-hand side of the balance sheet. They are divided into current assets, those expected to be converted into cash within 1 year, and non-current assets, those expected to be held for more than 1 year. Common current assets include cash, accounts receivable, and inventory, while non-current assets can include property, plant and equipment, and intangible assets. Identify the liabilities. The liabilities are listed on the right-hand side of the balance sheet. They are also divided into current liabilities, those expected to be paid within 1 year, and non-current liabilities, those expected to be paid after 1 year. Common current liabilities include accounts payable, taxes payable, and short-term loans, while non-current liabilities can include long-term loans, bonds, and deferred tax liabilities. Calculate the company's equity. The equity is the residual interest in the company's assets after deducting liabilities. It is listed in the bottom section of the balance sheet. Common components of equity include common stock, retained earnings, and treasury stock. Analyze the ratios. Once you have identified the assets, liabilities, and equity, you can use the ratios to analyze the company's financial health. Some of the important ratios include the current ratio, debt-to-equity ratio, return on equity, and gross margin, which we discussed earlier in this video. Look for trends. Finally, you should look for trends over time. Compare the current balance sheet with previous ones to see how the company's financial position has changed over time. You should also compare the ratios with those of other companies in the same industry to see how the company is performing relative to its peers. By following these steps, you can learn how to read a balance sheet of a company and gain valuable insights into its financial health. Thanks for watching this video.